Deconstructing SpaceX's massive market debut. June 12, 2026 marked a structural milestone in capital markets history. Space Exploration Technologies Corp, officially listed on the NASDAQ under the ticker symbol SPCX. The macro mechanics of the debut completely rewrote the corporate finance playbook. SpaceX priced its massive float of over 555 million Class A common shares at the top of its range at $135, instantly establishing an implied valuation of $1.77 trillion and pulling in a historic $75 billion in the primary offering. But the real story began when the stock was handed over to the secondary market. The opening cross printed at $150, an immediate 11% premium over the offer price, driven by a massive imbalance in institutional and retail buy orders. Sustained volume pushed the asset through local resistance levels to close its inaugural session at $160.95. This near 20% surge propelled SpaceX's market capitalization past the $2.1 trillion threshold, rendering it the sixth largest public enterprise on Earth and fundamentally validating a highly complex valuation model. To understand what this massive trading volume meant, we have to look past the top-line numbers and look at how the market processed the underlying fundamentals. First, the intense buying pressure reflects a structural willingness by the street to tolerate an extreme price-to-revenue multiple. Based on its fiscal 2025 revenue of $18.7 billion, SpaceX entered the public market trading at a trailing price-to-sales multiple of roughly 94 times. Under conventional fundamental analysis, that is an incredibly rich valuation, especially for an entity that booked a $4.9 billion net loss in 2025. However, the order flow confirms that the market is refusing to value SpaceX as a capital-intensive aerospace manufacturer or defense contractor. Instead, institutional desks are treating it as a diversified, compound infrastructure play. The aggressive bid side indicates heavy monetization assumptions for three separate pillars: the launch hegemony, a near monopoly on commercial payloads and heavy orbital lift capabilities via Falcon 9 and Starship; Starlink subscription engine, high margin recurring revenue from over 12 million global subscribers; the AI Alpha. Crucially, the premium is tied to the recent merger integration of XAI and X. Traders are effectively valuing orbital data centers and satellite-based AI computing networks as a massive growth layer. The day one capital flows signal that the street has fully bought into management's staggering $28.5 trillion total addressable market pitch. The underlying microstructure of Friday's tape revealed a fascinating tug-of-war. The syndicate banks, led by Goldman Sachs and Morgan Stanley, managed an order book that was reportedly oversubscribed more than 3 times. Retail participation was unprecedented, representing an estimated 20 to 25% of the overall allocation, with record-breaking auction volume routed through market makers prior to the opening print. But what really sustained the afternoon rally was the anticipation of systematic structural buying. Because of its sheer size, NASDAQ implemented specific rule modifications, fast-tracking SpaceX for inclusion into the NASDAQ 100 after just 15 trading days, provided it maintains a top 40 valuation ranking. Conversely, the S&P 500 maintains a strict mandate requiring 4 consecutive quarters of cumulative GAAP profitability, meaning index inclusion there is stalled until mid-2027 at the earliest. The immediate day one accumulation we observed was heavily driven by front-running institutional asset managers and passive tracking benchmarks adjusting their portfolios ahead of the mandatory fast-track windows. Despite the euphoria, the trading activity highlights several technical pressures that risk-conscious investors must monitor. The final capital haul could swell to $86 billion if underwriters exercise their 30-day Greenshoe option to purchase an additional 83 million shares, a move that will test the market's structural depth. Furthermore, a meaningful slice of these public funds is immediately earmarked to pay down a $20 billion bridge loan utilized for the XAI and X corporate restructurings, rather than directly funding capital expenditures for Mars infrastructure or Starship deployment. Ultimately, day one proved that the market possesses an insatiable appetite for mega-cap innovation assets. It successfully cleared an immense volume of shares, signaled deep institutional backing, and cemented a new paradigm for pricing frontier technology. But with a triple-digit revenue multiple and massive execution risks ahead, the real test begins when the initial index inclusion buying subsides and the company must begin delivering on its compounding growth forecasts. Thank you.